Good morning, everybody. And I say good morning because it is 6 a.m. Well, actually, by now it's 6:23. I had some setup to do. So good morning. Welcome to Adaptuition. My name is Chris, and I'm here to help you today with PoA, and more specifically, understanding how to do the provision for bad debts account. Right? Today's date is May 9th, 2019, and the exam is on the 13th. So we have just 4 days. So guys, before I get into the video, the first thing I want to do is I want to say thank you guys very much for watching what I do. Thank you for your comments, your appreciation. I am very happy that you guys are finding the content helpful. That is my aim, right? I started my entire private tuition program because I want to help people better understand PoA, math, add math. These things are not as difficult as you guys are led to believe they are. And I understand your frustration. I too had a lot of frustration with PoA. Math at the end of Form 2, for those of you who know what Form 2 is, the second year of high school, that's what we call it. At the end of there, my math mark was 36%. And I came 6th in class, so there was a problem other than me, right? Add math, my first 2 terms in add math, I got 23%, then I got 34%. Finally, I got some help and things got better, right? I even went on to do add math at A level. Now, back then it wasn't CAPE, right? But anyhow, and then in accounts, well, things did not start off great. They did not get better by magic. They got better through hard work. Anyhow, I'm ranting again, but I just wanted to give you guys some context for why I do what I do. As you notice, I'm not in my usual shirt and tie, like I said, because it's 6 a.m. I just got up and I'm like, at 5, and I'm like, you know what? I need to make a video today because the one I put out yesterday on trading accounts got some good traction, some good comments. So you know what? Today, we're going to be dealing with the provision for bad debts account. Okay, so like I said before, I'm not going to get into a lot of theory behind it. I will say just a few things, right? We create a provision for bad debts to satisfy an accounting concept called the prudence concept, also called conservatism. Now, what is the function of the provision for bad debts? It literally is to reduce the value of debtors on your balance sheet. Why? Why would we want to reduce the value of debtors on the balance sheet? Because we know for a fact, most businesses experience situations where some debtors do not pay them. And because of this, you see, the thing is, we will not extend credit. We will not sell to someone on credit if we knew for a fact they weren't going to pay us. So anytime we sell on credit, we're taking a risk. A risk that the person to whom we extended credit will not pay us. So how does this factor into the provision for bad debts? So we know by now, you guys are supposed to know you create at least 2 financial statements. It's really 3, maybe even 4 financial statements at the end of a financial period, a reporting period. The income statement, the statement of financial position, known as the balance sheet, and you have a couple others. If you go to CAPE, you'll deal with those. On the balance sheet, you deal with 3 major sets of items: assets, liabilities, and capital. You are supposed to present information that is reliable and accurate, that gives anybody reading the information a fair idea of your business's position, how much assets they own, the value, how much money they owe, and how much the owners contributed. If in your assets section you have the debtors item, and let's say you made all credit sales, and it was let's say $10 million. Let's say you're doing great business, all credit sales, and you go to get a loan and say, look, I have 10 million coming in. So I want a loan for, let's say, 25 million to boost my business, all right? And they say, oh, all right, cool, no problem, we'll give you this loan. But just answer a question. You expect to collect all of these? And you're like, well, yeah, I made 10 million in sales. People had to pay you. And they're like, well, no, people don't have to pay you. You would like them to pay you, but you know something, sometimes people don't pay. So this 10 million here, you need to write that down a little bit. You need to adjust it downwards. And like, but why? Well, because you mightn't collect all, simple as that. So the function of the provision for bad debts is simply to reduce the debtor's balance in the balance sheet to give a fairer representation of the amount of money that you will actually collect. So that's the only function, right? So like I said, I'm already 4.5 minutes into the video and I have to get this done quickly, right? And I'm just doing past paper questions today. I will do another video where I use my own original material just in case this one gets taken down for whatever reason, okay? All right, let's get into it. So shift to the side. Right, so this is the Jan 2018 question. So of course we start off by reading the question. So a company started business on 1 Jan 2015 and decided to maintain a provision for bad debts of 4% of its year-end accounts receivable. Accounts receivable for the first 3 years of operations were as follows. So they gave us 3 years with 2015, 2017, 2018. Prepare the company's provision for bad debts account for the 3 years 2015 to 2017. Now, before you even consider doing the T account, you need to do calculations. These calculations feed the T account, and they will also, just in the event you have to do an income statement extract or a balance sheet extract. Oh, sucks, I should have showed that too. Anyhow, I think I might do that on the fly if anything, right? So what we're going to do is, first of all, we're going to do a little table somewhere, or wherever you can manage it, head up the years, 2015, 2016, 2017. All right, debtors, 72,000, 84,000, 80,000. Okay, what is the provision? The provision here is 4%. Oops, let's change that. No, not you. Change the wrong thing. Anyhow, okay, so we have to multiply this, by that. What I'm going to do, let me fix that column. All right. Now, the change is by how much did your provision change from 1 year to the next. In the first year of operation, you would have had no previously existing provision. Therefore, the change would be the same amount as the calculated amount for the provision. Okay, now, all I'm going to do is I'm just going to drag this, I'm going to autofill it down. Right, so how I got these figures here, same thing. I multiply the debtors figure by the provision in both years. Right, so 3360 was 84,000 by 4%. 3,200 was 88,000 by 4%. Now, to get the change, you have to take the provision in the current year and subtract the provision from the previous year. Right, sorry, I had a little bit of a situation there. I had to deal with that. Okay, now getting back to what I was saying. So in 2016, from 2015 to 2016, your provision increased from 2880 to 3360. This here, 480, is the amount of the change. That is the amount that goes in the provision account and the profit and loss, by the way. Now, let's analyze the next year too. So from next year, we had from 3360 to 3200. Well, that's definitely a decrease. All right, so we use this information to fill in the provision account. Right, so in year one, it was 2015. All right, and this was, now adjustments for the provision are usually made at the end of the year. And usually we do it to the income statement. Right, now there is another method, another bookkeeping method for recording the provision for bad debts. The textbooks for Caribbean schools don't show that method, so I'm not going to show it here. It has to do with adjusting the provision via the bad debts account. Right, so that's not something with which I think most of you all are familiar with. If anybody else from somewhere outside the Caribbean is looking at the video and that's the method you use, that's cool, that's great. I will probably do a follow-up video using that particular method because I believe it might come on stream in the Caribbean sometime soon. Okay, so thanks for just being aware of that. Okay, so in the first year, in 2015, how much was the amount of the provision? It was 2880, but the change was 2880. All right, let's go. So 2880, boom. All right, at the end of that particular financial year, all we have to do is carry that balance down. Balance, yeah. Yeah, my typing fingers haven't really woken up yet, so you might see a few errors here and there in my typing. All right. Okay, so 2880. Oh, this column wasn't formatted properly. All right, you know what? Let's just leave that for now. The next year is 2016. At the start of the year, we're going to bring down that particular balance right at 2880. Boom! All right. Now, we're in 2016. In 2016, the provision went up from 2880 to 3360. That's an increase of 480. So once again, at the end of the year, so let me copy and paste. Why not? Let's see if I can save some time, because I think that's one of the reasons my videos end up being so long, because I might type in. All right, so it was 480. Boom. Okay, now, same thing. So 2016. End of the year is 31st December, and we are carrying a balance down, and that's equal to, well, whatever the total is here, right? Because there was nothing, okay, let's copy and paste. Copy, paste. Boom. Oh, nope. So let that be a lesson to you Excel users. When you're copying and pasting, always make sure your formulas pull what you want them to pull. All right, same thing here. Boom. All right. So once again, the income statement figure, the change in the provision is the amount that goes in the provision account. If it's an increase in a provision, it goes on the credit side, right? Now, I didn't explain why, so I'm going to do that very briefly. Remember I said earlier in the video, the provision for bad debts function is to reduce the debtor's balance in the balance sheet, in keeping with the prudence concept. How do we classify debtors? Debtors is an asset. What type of balance does an asset usually have? A debit balance. How do you therefore reduce a debit balance? By having a credit item, or in this case, an account with a corresponding credit balance that you will pair off or match off against that account with the debit balance, the asset account. Right? So the provision for bad debts actual designation in terms of classification is contra asset. It is used to be set off against another asset value. Sorry, it is used to reduce the value, carrying amount, the value in the balance sheet of a particular asset. The provision for depreciation is also a contra asset as well. Anyhow, that's the next video. I'm going to try to get out to you guys before Monday. Well, in this current exam season. If it's out already, then great. Okay. Right, so now let's go once again, 2017, right, start of the year, balance brought down. All right, this is not going to put from the same thing. Right, I knew that. Let's put that there. Okay, now in 2017, we have something interesting happening. We have a decrease in the provision from 3360 to 3200, a decrease of 160. Now, the provision currently has a credit balance. Therefore, to show a reduction in a credit balance, we will have to do what? We'll have to debit the account. So 2017 now, at the end of the year, the income statement amount, it will be 160. And the balance carried down will simply be equal to the difference between both sides. That minus that. Let's get some stuff going there. Boom. Right, 3200. And then in 2018, you can simply show the balance being brought down. Sorry, my bad. January 1st. Balance brought down equal to 3200. Right. And that is how you do the provision for bad debts account. Okay. Now, what I do want to show you guys is how to do the income statement extract and the balance sheet extract. Okay. So just give me a sec. I need to modify all my sheets, so I'm going to do that all at once. Okay, so I'm going to skip a line here. I'm going to put income statement extract for the year ended 31st December. All right, Okay, so in this particular case, we have two things we need to do. We have 2 years where we have increases in the provision, and we have 1 year where there is a decrease. The increases in the provision are shown as credits to the provision for bad debts account. The other account affected by the transaction is the income statement. If you're crediting this account, the other account has to be debited, and debits to the income statement are shown as expenses. Well, most of the time anyway, take it, right? So what I'm going to do now, you're noticing I'm leaving some space here. I'll tell you why in a little bit, right? So less expenses. Right, so I'm just going to abbreviate because I don't have much space. Provision for bad debts. So we have 2 years where the increases, 2015 and 2016. Let's let's leave them there. So in 2015, the income statement amount was 2880, and in 2016, the income statement amount was 480. So we put that there, 480. Now, in this third year, 2017, we had a decrease in the provision. The decrease in the provision is debited to the provision account. Therefore, the other account that has to be affected will have to be credited. Credits to the income statements are revenues or increases. Now, the major revenue we have in the trading, well, the income statement is sales. So any other revenues, well, it depends, I guess, who showed you how to do it. Any other revenues besides sales are usually added to gross profit. So gross profit, add other revenues, and once again you can put provision for bad debts. I just need to get one extra line going here, and this is the 2017 year, and that was 160, which matches with this item here. All right, cool. So that is the income statement extract. So once again, increases to the provision are shown as credits in the provision account, which means they are debits in the income statement. Debits to the income statement most of the time are expenses. Well, actually, they're all expenses. It's just certain ones will go up in the trading section. If you saw my video on trading accounts, you can check that one out. I didn't talk too much about debits and credits there, but you could get an idea about what goes where. And if there are any decreases in the provision, those are debited to the provision account and hence credited to the income statement. Credits to the income statement are revenues. This revenue is not sales. It's not actually money coming in. It's just a bookkeeping entry, by the way. It's a non-cash item. But it's added to gross profits, right? Some other revenues that would be added here would include stuff like commissions received, discounts received, rent revenue received, dividends received, interest revenue received, all that sort of stuff, okay? Right, I do want to show you guys the balance sheet extract. I'm going to have to scroll across a bit for that. Okay, so this is the balance sheet extract, oops, ECTS, all right, as at 31 December. Okay, now why I do that is because the way I present my balance sheet extract, I kind of go across as opposed to down. And let me explain why. So we're going to be in the current asset section because debtors is a current asset. And this is going to be debtors. Now of course, they're calling it account receivable as of late. So please feel free to call it that, provision for bad debts. And the difference is called net realizable value. Net is a word that means after all deductions have been made. So this is the value of debtors after all deductions have been made. The necessary deduction would be the provision for bad debts. Realizable comes from the word real. It means to make real or to actually get. Right? So when they say to realize your dreams, it means to make them come true, to make them real. Realizable means what is the actual value? Well, the value we will realize. Okay, so what I'm going to do, I have 3 years worth. I have 2015, 2016, and then 27, not 21 or 7. All right, so we're going to put those there. And then we're also going to put dollar signs. Right, so in 2015, I had 72,000 worth of debtors. The provision for bad debts was 28, 28, not equals, I want a minus sign. Thank you very much. 2880, and we will do that. Okay, I just want to get a format because I don't like when things are not formatted properly. Okay, that's good, and we're going to put some lines there. Nice. So all we're going to do now is put the rest of the figures. All right, so, right, 84,000. The provision in the second year was 3360. And we're just going to pull that across by the fill handle. Boom, 69,120. And in the final year, it was 80,000 minus 3,200. And then we're just going to pull that across. Boom. All right. Okay, so this is how you tackle a provision for bad debts question. Okay, so I'm already at the 20-minute mark, and I do want to do, there are 2 or 3 more questions I want to do primarily because this is a very simple one. It's simple and straightforward. It just had the provision account being created. It had the creation, 1 increase, 1 decrease. I added the income statement extract and the balance sheet extract. Matter of fact, I want to shift that down a little bit, right? Just to kind of match it up. Okay, so the reason I want to do a couple more is because there were a couple what do you call it? Different items, so they weren't as straightforward as this one was. They weren't entirely difficult, but less talk and more showing, right? So what I want to do is I want to just ungroup those things. I want to go across here. Right, so I need to clear out a lot of stuff here that we might be using. Okay, so let's get that. So I want this to be the Jan 2010 question. This is Jan 2016. I'll come back to that. May 2012 was also a nice one to do, right? Jan 2010. Okay, so this one, right? So this one was part of question 4. As you can see here, it was very T account centric. You had the provision for bad debts followed by expense and revenue accounts, right? We're not going to do those today. I may have done those in a previous video on how to do expense and revenue accounts. You can take a look in the videos for that. So yeah, we're just gonna go right here, right? The Garrett Fruit Company started business in January 7, made all sales on a credit basis. Being prudent, management decided to create a provision for bad debts of 2% of the year-end debtors. The debtors for the following 3 years were as follows, right? 2007, 8, and 9 values. Prepare the provision for bad debts account for the 3 years. Okay, so what we're gonna do is we're gonna do the full works. The calculation, the T account, the income statement extract, and the balance sheet extract, just for the sake of practice and illustration. Okay, so let's get these years going first. Whoops, nope, that was not the correct year. 2007, 2008, 2009. Now, just by the way, I am very aware that Excel has a lot of capabilities that could allow me to automate this and get everything done with just a couple of keystrokes. But the point of this is not to show off Excel, it's to show you guys in detail how to approach these questions. And that means it's going to be a little more time consuming. All right. Now, so 25,000 was the debtors in the first year, 27,500, 20, whoops, go down, 22,500. The provision was 2%. Okay, I guess I needed to format that too. Lovely. Let's put that there. Right, so what we're going to do is that this is equal to that multiplied by that. Whoops, nope, that. And like I said, I'm going to fix that column. Now I'm just going to pull it down. So I've multiplied 25,000 by 2%. I'm just going to pull this down to copy the calculation. So it's 27,005 by 2%, give us 550, and 22,500 by 2% will give us 450. So the change in the first year was equal to 500. Thereafter, it's always the current provision minus the previous provision. So there's an increase of 50 here, and as you can see, there's a decrease of 50, of 100, sorry, my bad, 100. Okay, so now it's time to get the T account going. Okay, so let's just push that across there. We'll put that on that side, and then we will pull up this piece here. All right, so let's zoom in on that. Okay, so in 2007, which is the first year, we have the adjustment at year end being income statement. We have 500, right? That's in 2007. Now we will have 2007 on this side, 31/12, balance carried down, 500. Okay, so what I'm going to do, let's just get those things input quickly. Lovely, right? So 2008, that is still 2007, clearly. All right, so we have January 1st, we have balance brought down, that's 500. After 500, we have an increase of 50 to carry the balance up to 550. So at the 31st of December 2008, why have 2007? Again. Right, so we have income statement. Sorry, I make weird sound effects sometimes. Okay, so we have the increase of 50. That was at the 31st 12, and the balancing figure, the balance carried down, will be equal, of course, to the total on this side, because there's nothing else on that side, is there? Right? So 550 is carried down to 2009. That's 1st of Jan. Slash. Val brought down, right, equal to 5. Now, by the way, in your exam, please don't abbreviate as much as I am. I'm just trying to abbreviate to save some time. This video is already 25 minutes. I wanted it to be 15. All right, so 31st 12. Okay, whoa, hold on. Right, remember, in 2009, there was a decrease in the provision. Decreases in the provision go on the debit side. Why is that? Because this is a contra asset, which follows the opposite rules to assets. So if you have to decrease it, you have to debit. Now the balance carried down at the end of the year, I'm going to leave it. All right, it's the difference between the two sides. So 550 minus 100, which will tie back to 450. And January 1st, we have Val brought down 450. Right, so once again, so check this, right? The change figure is the income statement figure. So every figure labeled income statement inside of here matches with the figures in this column, right? The balances will match with the provision. This is the balance and the provision carried forward. So 500, 550, and then 450. Okay? Now, let's check out the income statement extract. So in 2007 and 2008, we have increases of 500 and then 50 respectively. 500, 50. Right? I should not have deleted that. Add other revenues. And this is the provision for bad debts. Right. In 2009, there was a decrease of 100. So that as a credit to the income statement, and hence it's added to gross profit. Okay? Now, in the balance sheet extract, right, we could actually just pull it from right here. Actually, I'll just scroll up with this one and just zoom in because I don't want it to be too small for you guys to see. I keep forgetting some of you guys are watching on your phone, and I'm mindful that this might be a little small to see on your phone, so I do apologize for that. It's 25,000 minus 500, minus 500. Right, 2016 was 27,500 and then minus 550. And then we had 22,500 minus 450. Oop. Okay, let's just double check that. That looks good. That looks good. That's it. Right. Okay, so far we have done 2 provision for bad debts questions that were pretty straightforward, more or less the same. So what I want to do now is I want to take a look at the 2016 question, which had a bit of a slight difference in it. Okay. So on 1st Jan 2013, the Gargamel Company showed a balance of 12,000 in its provision for bad and doubtful debts account. Gargamel Company provides for bad and doubtful debts of 5% of its year-end account receivable. Account receivable at the end of the 2 years were as follows. Right, so 31st December 2013, 270, 31st December 2014, 255. Starting with the provision for bad debts balance on 1st Jan 2013, prepare the provision for bad and doubtful debts account for the 2 years ended 31st December 2014. So in reading it, it says on Jan 1st 2013, the Gargamel Company showed a balance of 12,000 in its account. So there is a pre-existing balance brought down in the account. In the other 2 examples, we created the account from scratch. There was no balance pre-existing in it. So now you have to be mindful of that particular situation. So if you want, what you could do even before you do your calculation, okay, let me zoom out. Zoom back in, right. Even before you do your calculation, you may want to do, okay, 2013, Jan 1st, balance brought down 12,000. Just to remind yourself, hey, I have a balance in the account already. And what that means is that 2013, you should put, 2012, my bad. The provision is 12,000. Right, now why I put 2012 is because we have brought it forward to 2013, which means that the provision here was the 2012 provision. Right, now in 2013, we have debtors of $270,000. And in 2014, we have debtors of $255,000. The provision is 5%, and we have to multiply, right? Hey, give yourself, right? This by that. And same thing here, we have to multiply this by 5%. So here, right, so in the first instance, from 2012 to 2013, there's an increase in the provision of 1,500, right? 13,500 minus 12,000. In the second instance, we have a decrease of, I believe, 750. Okay, so we only had 2 sets of calculation to do, but you had to pay attention to the fact that there was a pre-existing provision in the account. Okay. 2013, balance brought down was 12,000. There is an increase of 1,500. So at the end of the year, we're going to have the income statement figure of 1,500, which means at the end of 2013, 31st December 2012, the balance carried down will be equal to, well, 13,500, because we know that's the amount it's supposed to tie back to. All right, and 12,000 plus 1,500 is 13,500. All right. Now, January 1st, 2014, I keep putting balance and whatever, right? It's 13,500. At the 31st of December 2012, nope. In 2014, we have a decrease. Decreases to the provision go on the debit side of the account. 31st/12, income statement, we have 750. And the balance carried down, therefore, will be the difference between 13.5, well, the total on the credit side and the total on the debit side. Well, the current existing total. Okay, right, 12,750, and in 2015, we bring that balance down, 12,750. Oops. Right, so 12,750 matches with 12,750 across here, and 13,500 matches with 13,500 across here. Okay, sorry if I'm talking fast, I'm just trying to get this done, right? Because I have class today, right, in a few hours, and I want to edit this and upload it. Okay, income statement extract. So in 2013, there was an increase in the provision of 1,500, whereas in 2014, there was a decrease in the provision of 750. All right, so, oh wait, I didn't change those years in 2010, did I? Whoops, nope, I didn't. So 2007, 2008, 2009. Sorry, I'm pretty sure you get some of you guys, but sir, you didn't change that? I didn't hear you, sorry about that, I didn't hear you. Okay, so let's go ahead and change these as well. So 2012, I have to sneeze. Sorry, edit that out, eh? Don't leave it in. I know what talking to myself. Okay, cool. So let's take out the provision. So 2070 minus 13,500, and then 255 minus 12,750. Right. Okay, so the biggest difference in this particular question was the fact that we had a pre-existing provision in the question, and they told us that here, first line. So that's why I say it's very important to read your question carefully. It's your paper. Write up on it, make notes. I'm not gonna say highlight and that kind of stuff. Make a circle, put an asterisk. If you have different color pens, maybe. But in the exam, you really don't have time to go fancy. Keep it simple. All right. Okay. Do I have time for one more question? Let's squeeze it in. Let's see what happens. Right. That's the 2012 question. The 2012 question was the last time that they brought the provision for bad debts in the May paper. Sorry. Right. To the best of my knowledge. Right. And I'm pretty sure about that because every year when I get the paper, I do a breakdown of it. I have a spreadsheet with details of the questions going back from 2019 Jan all the way back. Well, for Jan I only have up to 2007, but for May I have up to 1999. So I know what came and went. Not by heart, that's a lot of stuff to keep in your brain, but maybe one day I'll memorize it. Okay, anyhow, where was I? Oh, read the question. Step 1. Sales ledger of, okay, no, actually the first part was you have to write off these 3 receivables as bad debts. Prepare the journal entry. Okay. The remaining receivables total 28,320 at 31st December 2010. Mr. JJ believes that 10% of these outstanding receivables are likely to become bad debts. He wishes to make adequate provision for those debts. Prepare the journal entry with narrative to create the provision for doubtful debts account. Okay, so that's something we haven't done, journal entries. But first things first, we need to calculate. The debtors figure is 28,320. And the provision amount in this particular case is 10%. So the provision that's going to be calculated is simply this multiplied by 10%, and I'm going to fix that so I can just pull it down. All right, so the change in this case, if he's creating it, you're now going to get 2832. All right, so what I'm going to do, let me scroll across, and I'll need to zoom out a little bit to create some space for the journal entries. All right, and I'll just pull across that column here. And right, so I'll head up general journal. Let's put a couple of money columns. And right, so when we're creating the provision for bad debts, we have a debit to the income statement. And in this case, it was for the full amount of the provision because it's now being created. Right, that's 2832. And we credit the provision for, well, let's call it this bad debts for now because I'm kind of low on space. Not really. Anyhow. And it says with narrative, right? So let's, all right, so to record the creation of the provision for bad and hold on 1 second, I didn't wrap it, did I? No. Right, bad and doubtful debts of 2832. All right, so keep it simple and straightforward. I know a lot of you guys have some issues with journal entries, the narrations especially, but keep it simple. Okay, all right, so we did that, and in part 2 says prepare. Okay, so on 31st December 2011, Mr. JJ's receivables after bad debts total 25,000. So 2011, let's go there now. 2011, 25,000, and we have to find 10% of that, which will be, guess what, 2,500. And the change, once again, is the current provision minus the previous provision. So we have a decrease of 332. Draw up the provision for doubtful debts account for the 2 years, January 2010 to 31st December 2011, to show the change in the provision, balance the account at the end of each year. Okay, so in 2010, the 31st of December, we have the creation of the provision for bad debts for 2832. And at the end of that year, well, around the same time, when we make the thing, we're going to just carry the balance down. That's going to be equal to the same 2832. Okay, so in 2011 now, January 1st, balance brought down 2832. Now, in 2011, there's a decrease. Decreases in the provision have to be debited to the account. Saying the wrong thing, misleading people, children. Income statement 330. Let's try that again. 332. And that balance carried down after that, of course, will be the difference between this side and this side. So when we do that, we will get 2,500 and 2012, Jan 1st, balance brought down. Why is it capitalized? I don't know. Oh, I know why. I press shift instead of space, slash, 2,500. Okay, guys. Let's do this very quickly. 2010, there was an increase in the provision 2832. In 2011, there was a decrease in the provision of 332. And here now, right, 2010, it was what, 28,320, and we had to minus 2832. And in 2011, we had 25,000, and we had to minus 2,500. Okay, so there you go. So that was how to prepare the provision for bad debts account, starting with your calculation. And remember, it is the change. The change is the amount that goes in your provision account, your income statement, your journal entries. So that column there is especially important. The provision amount will mainly be shown in the balance sheet, but of course, yes, you will see it as the balance carried down from one year to the next, right? That is probably the biggest problem most people have with the provision for bad debts account. They don't know what amount goes where. So if you need to rewatch this video a couple times, that's fine by me. All right, but I know time is limited for quite a bit of you. For those of you finding this video after I created it and after the exam season in 2019, if you have any other questions about the provision for bad debts, please let me know. Like I said, I will try to do a follow-up video sometime in the future, explaining in a bit more detail the theory behind the provision for bad debts, giving a bit more context to it. I know a lot of times we just do things because that's what Sir Om is said to do, that's the calculation, but there's a reason. Everything in accounting has a reason. It really is a lovely subject, a wonderful system that's been in use for a few centuries well, and I know it can seem very overwhelming. You guys have no context to it. You don't understand where it's used, why we're doing this, apart from I had to pass CSEC, I had to get good grades, I had to do CAPE, I had to get into university. It goes way beyond that, and I'm sorry if your experience so far has not led you to understand that. Don't hate accounts. It's not accounting's fault, right? I'm not saying it's a teacher's fault either. I think the system we have in place of education needs to be adjusted, and I think that they are trying, but of course all things take time. You need to find your passion. I know that sounds very cliche, but it's true. You have to try things to know if you like them or not. But you have to be mindful that no matter what you try, you're going to have work involved. You're going to have times where you feel like you have no idea what you're doing. You're going to wonder, why is all this work necessary? Work is necessary because we need to get things done. If what you are doing is not what you are passionate about, find what you are passionate about. But remember, you have to eat. And to eat, you need to buy food. And to buy food, you have to have money. And to have money, you have to have a J-O-B. What is that? Job, right? You had a job, right? Unless, of course, your folks financing it. And in any case, I'm not judging if that's the case, that my folks financed me for quite a few years, even when I was in university, right? But at the end of the day, you need to be able to stand on your own 2 feet and do what it is that you know you have to do. And that could change. Anyhow, as soon as I get preachy, we're almost at the 45-minute mark. So guys, I hope this video helped you. If it did, please give that like button a click. Feel free to share it. Please subscribe. I am very appreciative and grateful for each and every one of you who do. And I'm hoping to get some more videos out to you guys before the exam. I know it's on Monday, right? I'm speaking, of course, to the class of 2019. Anybody past this? Well, that's the situation, right? We were 5 days, Friday, Thursday, Friday, Saturday, Sunday, 4 days away from the exam, right? Anyhow, guys, I need to make a move because, like I said, it is now 7:07. I've been recording for about 45 minutes. So this is actually one of the shorter videos I would have made, interestingly enough. But I have to call it quits there, alright? So I had to eat, I'm real hungry. Anyhow, guys, right? If you're following Big Bang Theory there and then just now too, get them some love. And I hope everybody saw Avengers Endgame by now because I really want to talk about it, but I don't want to spoil it for anybody. Okay, guys, so this is Chris signing off. And until next time, if what you're doing is not working, if the way you're studying is not working, you need to change. You need to adapt because change is the only constant. All right, bye.